Yes, it's April 15th, which is typically tax day. Yes. Well, not this year. So this year, tax day has been delayed and pushed back due to the coronavirus pandemic to allow people more time to get their tax information prepared. And so we have now until July 15th to prepare our taxes. And I wanted to share information around how to minimize our taxes this year and most every single year. But I wanted to start by saying this is something I like to do in live speaking engagements, and that is to kind of hold up this dollar and say, is this the dollar that you take to the grocery store? And most people say, yeah, that looks like legal tender. And it is. It's a true, genuine dollar. But I say, no, we actually take only this much of the dollar to the grocery store because of federal income tax. So maybe that's 25%, or maybe your bracket is even higher. And if you're in a state that levies a state tax, an additional fold has to come off of that dollar. And that's the dollar that we're taking to the grocery store. Often I talk about inflation, and that even further diminishes the dollar, but we're not in a high inflation era now, such that I won't talk about inflation tonight, but rather about taxes and how to minimize our taxes so that we can have more of this dollar in our bank and investment accounts and not send it senselessly to the government. Now, I held up the dollar, and I haven't been to the bank in a while because of the pandemic, but imagine a $10 bill or a $100 bill. And now we start to feel the effect as being very sizable, worth our note, I might add. So listen up as to how we can give you relief on your income taxes, which otherwise adds to your investment values. Now, I want to say from the top, I'm quite aware that this pandemic has caused people's focus to be on things other than money. And that is wholly understandable and a correct prioritization of values. These are the very times that fee-only financial advisors like Asta and myself provide the services that it's really not in your bandwidth to think about and to dissect and discern strategies to get you closer to your goals. So help yourself by getting advice from professionals because it will be well worth the fee you pay. Now, let's talk about dollars and cents because that's the purpose. And at the end, we'll give you some free resources that you can reference as a review, if you will. Now, the IRA contribution deadline has been delayed along with the tax filing deadline to July 15th. And I might add, you don't have to do anything. You don't have to notify the IRS that you won't be postmarking it by midnight tonight, and that you want to take advantage of those several 2 months extension, if you will, May, June, July, 3 months, excuse me. But what I want to talk about is the IRA contribution limits are still $6,000 for traditional IRAs and Roth IRAs for people under age 50. But if you're over age 50, you get that extra $1,000 of what they call catch up to extend your contribution amount up to $7,000. And because of longevity and other things that we're going to talk about on future Live at Fives, it's probably well worth your maximizing those contributions if you're able. And I understand this year may be difficult for some people. In addition, what you've already heard about are the free checks that are coming, and those monies from the federal government are not taxable to you in 2020. For single taxpayers, you'll receive a $1,200 check if your adjusted gross income is less than $75,000. If your adjustable gross income is higher than $75,000, but not quite to $99,000, you will have a phase out of 5% for $5 reduction for every $100 of additional AGI, adjusted gross income, over the 75,000. And for single taxpayers whose AGI is over 99,000, you will not get tax-free monies from the government. Likewise, a married filing jointly taxpayer unit will receive $2,400. And if they have qualifying dependent children under age 17 that they otherwise declare on their taxes, an additional $500 per said child, if their combined adjusted gross income is less than $150,000. If it's $150,000 up until $198,000, there'll be that similar phase out. And for adjusted gross income for married filing jointly taxpayers over 198, there will be no tax-free monies coming into your bank account. Let's talk about how we're paying our bills, especially if our jobs are in question, or we have been fired, or we have been laid off or furloughed. And I've said before that there are a number of government relief programs already underfoot and in process, and there may be more to follow. So I want us to exhaust all of our liquid monies, available monies, before we think about raiding our 401ks at work or our 403bs or our IRAs, because they are really set aside for retirement and not before. Now that said, the delay in having to pay your mortgage, for example, and a lot of car payments and student loan debts and so forth is really going to gut people a break here in the near term. And it may be that you can trim some of your household expenses in a way that doesn't require you to tap into your retirement accounts. And that's what I'm suggesting that you attempt to do. But if you have to go in to your IRAs or your 401ks, then you could do so under your 401ks under a loan provision. And a loan provision changed from the lesser of 50% of your account balance, or $50,000. That's what the old rule was. But due to the CARES Act that came out after the pandemic, you can borrow up to 100% of your account value with a maximum of $100,000. Now, the caveat here is that if you lose that employment, if you get fired after you take the loan, unless you're able to repay that, you have to declare that as taxable income on your tax return. Now, again, that might not be horrible compared to the alternative. I'm simply throwing it out as a caveat. In general, it's a tax-wise move to borrow from a 401k, in so much as the repayment of that loan is automatically deducted from your paycheck. So what's so great about that? It happens, right? That loan gets repaid, and you're paying yourself back that interest on which the loan was based. So there's an interest charge to take the loan, but when you're repaying it back, you're paying yourself back that interest. So it's actually a pretty good move from a tax angle. If you must take an absolute withdrawal, you don't think there's any chance that you can borrow and pay it back, or you fear that you're not going to have that same employment, or you've already been let go, then you can take an early distribution from your IRA without any 10% penalty. So heretofore, a person taking monies out, withdrawing before 59 and a half, they were taxed an additional 10% early withdrawal penalty, in addition to the taxation bite that would follow. But that's been waived, and one can take out a withdrawal up to $100,000 without that 10% penalty if they're under 59 and a half. If you're over 59 and a half, you can take it out without an early withdrawal penalty anyway. The repayment has been extended to 3 years, so that if you have to take a withdrawal now, then you get reemployed and you can afford to pay that back. You can do so over the next 3 years, which does give us a very, very attractive window to exercise that option. For those of you who are over age 72 and otherwise would be required to take an RMD, required minimum distribution, it is waived for 2020. You do not have to take monies out of your 401k or 403b or IRAs. Instead, you can let that money sit there in the investments and allow those investments to recoup the losses that they have otherwise suffered on paper. And if history is any indicator of what we can anticipate in the future, we will recover. Yes, we will. These markets will recover as markets have always recovered. It's just the ambiguity is how long will it take? But for long-term investments, which we have typically reserved for stocks anyway, it's not something to get terribly short-term about in our focus. Let's just continue to think of those accounts as long-term. And now we don't have to pull monies out at depressed prices. A charitable deduction allowance has now been introduced for those of you who are filing according to the standard deduction. A couple of years back with the Tax Act, you may not have been able to deduct any longer your property tax and so forth, such that many people went to the standard deduction in lieu of the itemized deduction because it benefited them to do so. But as you know, the standard deduction doesn't give you any individual itemized deductions for each of those line items. And now the government is realizing that these 501c3 organizations, these charities, are in desperate need for donations, and they want to incent you to donate to them. And so they'll give you a $300 deduction for charitable contributions. Again, has to be a 501c3 organization. If you're in any doubt, look that up on the computer or ask the organization to whom you will wish to make those donations. Additionally, the 60% limit that heretofore was in place for cash contributions, you couldn't cash contribute more than 60% of your adjusted gross income. That has been changed to 100% of your adjusted gross income. So if you find yourself in a position of having some extra cash, please consider giving monies to organizations that are in sore need of those very donations at times exactly like these. Remember the health savings accounts, and you can continue to contribute to the health savings or HSA accounts until that July 15th extended deadline as well. Those limits are $3,500 for an individual and $7,000 for families. But again, if you're over age 55, you can get another $1,000 contribution stuffed into that HSA plan, which is typically held for medical expenses, deductibles, co-pays, and so forth. But if you can afford, and I don't know as you will, you can afford to keep your hands off of that, that grows tax deferred, basically tax-free for a long time, maybe forever. And you might be able to use that compounded balance as an extra retirement account. So go ahead and fund that HSA account because it will absolutely compound in an astonishing way if you can afford to not withdraw from it. And finally, let's talk about tax loss harvesting. Typically, I'm not a fan of anybody selling assets at these depressed prices because we're locking in that lost gain, if you will. We're locking in that lower price because if markets, and I do think that they will recover, if we've sold here at the bottom or anywhere near the bottom, we won't be at the party for the gains. However, if you are in a high tax bracket and you feel that going ahead and locking in that tax loss, which might be significant, groups of zeros, as I call it, Uncle Sam will share in that tax loss with you. In other words, you'll write off that tax loss. Imagine if you have a $10,000 capital loss, or at a zero, 100,000, and you're in a 30% tax bracket, you just saved $30,000 for that $100,000 tax loss, or bring it down to some of your levels. If you have a $10,000 capital loss and you're in a 20% tax bracket, you take the 20% times your tax loss, $10,000, and you just saved $2,000. Uncle Sam is partnering with you. That's the effect of tax deductions. But I don't want you to just spend the proceeds unless you must. I want you to buy a similar security, and that security will be purchased at a very rock bottom price, right? And have the ability to appreciate as the markets recover. You must avoid, however, selling one stock or stock mutual fund and buying that same one back again within 30 days. Else you will negate your tax loss, which is the entire point of the exercise. It's called the 30-day wash sale rule. don't run afoul of that. And it's a little dicey. It's tricky. Do not do this blind. If you have any question about that, seek the advice of your CPA or your fee-only financial advisor. We've been doing this for weeks now for our clients. And in fact, if our returns on our investments are negative after the year end, if you will, that's never comfortable. Yet what makes it more doable and viable is, as we have benefited our clients through these tax loss strategies, we have added value to their account. And basically, to the extent that you can't use a tax loss in the current year offsetting capital gains, you carry that tax loss forward. Imagine what capital gains rates are going to be like in the future with the debt we're taking on with all of these rescue packages. Believe me, capital gains rates will be high. And if we have logged hundreds of thousands of dollars or even tens of thousands of dollars of capital losses that can be carried forward, that is dollars in your account. That is causing your future tax bills to be a lot less. And so you keep that money in your account instead of having to fork it over in current taxes. And the other way this could be an opportunity for some of you is if you have a position of stock or a stock mutual fund, for example, that's appreciated very, very nicely over the years or decades. And you say to yourself, I'm really overweight in that one security or two securities, but I can't afford to sell it because I have to pay a capital gain. Well, whatever capital gain you would have to pay to sell it, you could offset with a tax loss sale. And now you've lightened up your overweight position, which we always suggest you do to be properly diversified, all the while giving yourself more balance and using that tax loss to offset dollar for dollar that tax gain. So it's a great way to achieve that strategy of lowering your taxes and diversifying your portfolio. And finally, we do this thing called minimization of from which account is it going to cost you the least amount of tax dollars to give you the monies that you need. We have a lot of retirees that are in the decumulation phase. So they say to us every year, okay, this year we'll need $20,000 of extra cash from someplace to supplement our Social Security and maybe pensions or other income streams. A lot of them have admitted to us in the past, they just say, oh, I just sold more additional amounts of my IRA and okay, I got taxed on it, or I just sold some stocks and I paid the capital gains on it, or I just took some dividends. Don't just do that without knowing the impact. We'll take that tax software and we'll run that mouse along the bottom. And if you need an extra $20,000 or $30,000, we'll get down to the dollar and we'll say, okay, the cheapest money here, the cheapest dollars you can tap are $12,000 from your tax gains on your investment portfolio, an additional $8,000 in an additional IRA withdrawal, etc. We'll dovetail those strategies to make sure that you get the cash flow you need at the cheapest possible tax rate. And I guarantee you that that adds up over time. I'm going to suspect that's going to more than pay the fee that you would pay your fee-only financial advisor. Austin and I would love to chat with any of you about your specific circumstances. In the meantime, go to www.empoweredretirement.com/resources, and you can tap into some of that which I outlined tonight, as well as some other matters and details that I think will be empowering. In the meantime, if you found this helpful, please share it to your friends, because we want to get the word out about being in control of your money to keep more of your hard-earned dollars. Now back to the important part, and that is your safety and that of your friends and loved ones. Until next time, stay safe. Let's all support each other, and however we can help you, financially or otherwise, just give us a call.